Breaking news from the White House, and this one reveals a stunning disconnect between political ambition and economic reality. President Trump just held a meeting with America's biggest oil executives, asking them to invest at least $100 billion into Venezuela's collapsed oil industry. But here's what nobody saw coming. ExxonMobil's CEO stood up in that room and delivered a message that sent shockwaves through the administration. He called Venezuela uninvestable. Let that sink in. The president wants $100 billion flowing into a country that the world's largest oil companies say isn't worth the risk. Today, we're breaking down exactly what happened in that White House meeting, why the oil giants are pushing back, and what this means for Trump's ambitious Venezuela plan. We'll examine the staggering financial obstacles, the legal nightmares these companies face, and whether American consumers will ever see the lower gas prices Trump is promising. President Donald Trump recently convened an emergency meeting at the White House with the CEOs of America's most powerful energy corporations. The attendees included ExxonMobil CEO Darren Woods, ConocoPhillips CEO Ryan Lance, Chevron Vice Chairman Mark Nelson, and representatives from Spain's Repsol and Italy's Eni. Trump's pitch was direct and ambitious. Invest at least $100 billion to rebuild Venezuela's devastated oil infrastructure. According to the administration, this would unleash the South American nation's vast energy reserves and deliver lower gas prices to American families. But what happened next wasn't what Trump expected. ExxonMobil CEO Darren Woods addressed the president directly, stating, "We have had our assets seized there twice, and so you can imagine to re-enter a third time would require some pretty significant changes from what we've historically seen. Today, it's uninvestable." Those words, uninvestable, represent a devastating blow to Trump's Venezuela strategy. And it gets worse. This isn't just about hurt feelings or past grievances. According to recent reports, Venezuela currently owes ConocoPhillips nearly $10 billion from previous asset seizures, while ExxonMobil is owed approximately $2 billion. These debts stem from Venezuela's nationalization campaign under former President Hugo Chavez, when the government seized foreign-owned oil assets and forced companies out of the country. International arbitration tribunals have ruled in favor of these American companies, but Venezuela has never paid. Here's the context you need to understand. Venezuela sits on 303 billion barrels of proven oil reserves, the largest in the world, surpassing even Saudi Arabia. Yet the country currently produces only about 1 million barrels per day, representing less than 1% of global oil supply. For comparison, Venezuela pumped 3.5 million barrels daily in the 1990s. The decline has been catastrophic, driven by decades of corruption, mismanagement, underinvestment, and crippling U.S. sanctions. Infrastructure has literally rotted away. Equipment has been cannibalized for parts. Technical expertise has fled the country. Think about a small business owner who watches their competitor shut down a thriving operation through incompetence and corruption, only to be asked years later to invest their life savings to revive it under uncertain terms. That's the situation facing these oil executives. Let's break down the technical and legal complexities that make Venezuela such a minefield for international investment. First, understand the magnitude of decline. Venezuela's oil production peaked at approximately 3.5 million barrels per day in the late 1990s. Today, that figure has collapsed to roughly 1 million barrels daily, a 71% decline over less than 3 decades. Industry analysts at Rystad Energy estimate that restoring production to even 2 million barrels per day would require $8 to $9 billion in new investment annually for the foreseeable future. But here's the kicker. Trump's proposed $100 billion investment figure isn't just ambitious. Experts are calling it fantastical. David Goldwyn, former U.S. State Department Special Envoy for International Energy Affairs and president of Goldwyn Global Strategies, told reporters that major oil companies like Exxon and Shell are not going to invest single-digit billions of dollars, much less tens of billions of dollars, without physical security, legal certainty, and a competitive fiscal framework. He estimates that smaller independent companies might invest roughly $50 million each over the next year, nowhere close to the $100 billion figure Trump floated. The legal framework presents enormous obstacles. Venezuela's past nationalization forced foreign companies to restructure their holdings, giving state-owned Petróleos de Venezuela, or PDVSA, majority control. ExxonMobil and ConocoPhillips refused and were expelled. Their assets were seized. Total, Chevron, Statoil, and BP agreed to minority stakes and stayed. Fast forward to today, and those seizures have resulted in massive arbitration awards. ConocoPhillips won an $8.7 billion judgment from an international arbitration tribunal. ExxonMobil was awarded $1.6 billion. Neither company has collected. What does this look like in practice? Imagine you own a construction company. A foreign government invites you to build infrastructure, you invest millions, then suddenly the government seizes everything you built without compensation. Years later, that same government, now under different leadership, asks you to come back and invest again. Would you? Not without ironclad guarantees, complete legal reforms, and protection mechanisms that simply don't exist in Venezuela today. Trump's solution to this problem is unconventional and raises serious questions. At the White House meeting, he told executives, "You're dealing with us directly. You're not dealing with Venezuela at all. We don't want you to deal with Venezuela." This represents an extraordinary assertion of U.S. control over a sovereign nation's resources. The administration has seized Venezuelan oil tankers, is establishing a sales process for Venezuelan crude, and plans to deposit revenues into U.S.-controlled Treasury accounts. Trump recently signed an executive order prohibiting U.S. courts from seizing these Venezuelan oil revenues, arguing that such seizures would interfere with U.S. foreign relations and international goodwill. But legal experts point to a glaring contradiction. If U.S. courts can't touch those funds, how will ExxonMobil and ConocoPhillips ever collect the billions they're owed? The companies were counting on those very legal mechanisms. Now Trump is essentially telling them, forget your past losses, we're starting fresh. ConocoPhillips CEO Ryan Lance addressed this directly at the meeting, calling for restructuring of the entire Venezuelan energy system, including PDVSA, and noting that the banking sector will need to help restructure Venezuela's debt and provide billions of dollars in financing. Compare this situation to Iraq after the invasion. The U.S. promised that Iraqi oil revenues would fund reconstruction. Despite massive American military presence and security guarantees, international oil companies remained extremely cautious. Production recovery took more than a decade. Iraq's legal framework, while challenged, was still more stable than Venezuela's current situation. Venezuela today faces not just infrastructure collapse, but also political uncertainty. The country is currently led by Delcy Rodriguez, former vice president under Maduro, serving as interim leader. There's no elected government, no constitutional process underway, and no clarity on long-term governance. Chevron Vice Chairman Mark Nelson offered the most optimistic assessment, stating the company could increase production by 100% essentially immediately and grow output by 50% within 18 to 24 months through disciplined investment. However, Chevron is the only major U.S. oil company that never left Venezuela, maintaining joint ventures with PDVSA through special U.S. licenses. They have operational infrastructure and relationships on the ground. ExxonMobil and ConocoPhillips would be starting from scratch in a country that burned them twice before. Think of it this way. Chevron is like a tenant who stayed in a deteriorating building and knows which pipes work. Exxon and ConocoPhillips were evicted tenants being asked to move back into a building that's now missing walls, with an unreliable landlord, no lease agreement, and previous eviction notices still unpaid. So who gets affected by this standoff between Trump's ambitions and corporate reality? Let's break it down by category, because the ripple effects are already spreading across the American economy and beyond. American workers and families were promised lower energy prices. Trump stated explicitly that one of the things the United States gets out of this will be even lower energy prices. But industry analysts are pouring cold water on that promise. Claudio Galimberti, chief economist at Rystad Energy, warned that Americans should not expect the situation in Venezuela to lower oil prices anytime soon. Why? Even under the most optimistic scenarios, meaningfully increasing Venezuelan production would take years, not months. The infrastructure damage is simply too severe. Consider a typical American family spending $400 monthly on gasoline and energy costs. They're hearing promises of relief. But the timeline for any Venezuelan oil reaching U.S. markets in significant volumes is measured in years, if it happens at all. Meanwhile, current oil prices remain elevated, and the administration's focus on Venezuela may be distracting from more immediate domestic energy policies. The impact on American oil workers presents a complex picture. Treasury Secretary Scott Bessent indicated that the administration might rely more on smaller independent oil companies rather than the majors, stating, "The big oil companies who move slowly, who have corporate boards, are not interested. I can tell you that the independent oil companies and individuals, wildcatters, our phones are ringing off the hook. They want to get to Venezuela yesterday." This suggests job opportunities for experienced oilfield workers willing to work in high-risk international environments. However, industry veterans know that working in politically unstable regions comes with significant personal and professional risks. Compensation may be higher, but so are the dangers. Small and independent oil companies face a different calculation than the majors. Bill Armstrong, who leads an independent oil and gas driller, attended the White House meeting and expressed enthusiasm. "We are ready to go to Venezuela. In real estate terms, it is prime real estate." Smaller firms with lower overhead and more risk tolerance might indeed seize opportunities that ExxonMobil and Shell won't touch. But here's the reality check. These companies typically invest in the $50 million range per project, valuable but nowhere near the scale needed for transformational change. And if political conditions deteriorate or legal frameworks remain unclear, these smaller companies lack the financial cushion to absorb major losses. We could see several small American firms losing significant capital in Venezuela over the coming years. Large corporations are treading extremely carefully. ExxonMobil announced it would send a technical team to Venezuela in coming weeks to assess conditions, but made zero financial commitments. ConocoPhillips praised Trump's actions, but emphasized the need for comprehensive legal reforms before any investment. Shareholders in these companies are watching closely. Institutional investors have fiduciary duties and cannot authorize risky deployments of capital without proper due diligence. Stock markets have shown muted reaction so far, with energy sector stocks trading relatively flat following the White House meeting, suggesting investors are skeptical that major capital deployments to Venezuela are imminent. Energy analysts warn that the current situation creates market uncertainty. When major investment decisions are delayed and political conditions remain fluid, oil companies cannot make long-term supply commitments, which ultimately keeps global energy markets tighter and prices higher. Industry experts and political analysts are weighing in with increasingly skeptical assessments of Trump's Venezuela oil strategy. David Goldwyn, who served as the U.S. State Department's special envoy for international energy affairs, delivered a particularly blunt evaluation. They are being as polite as humanly possible and being as supportive as they can without committing actual dollars. It's not really welcome from an industry point of view. The conditions are just not right. ExxonMobil released an official corporate statement following the White House meeting, carefully threading the needle between diplomatic support and corporate caution. ExxonMobil Chairman and CEO Darren Woods attended a meeting hosted by President Donald Trump to discuss the situation in Venezuela. "We are prepared to evaluate re-entering Venezuela if the right conditions exist, including legal certainty, commercial viability, and protection of invested capital." That phrase, "if the right conditions exist," is doing enormous work. It's essentially a polite way of saying not yet and maybe never. ConocoPhillips CEO Ryan Lance emphasized systemic challenges. As we think that big and bold, we need to be also thinking about even restructuring the entire Venezuelan energy system, including PDVSA. This isn't a minor adjustment. It's calling for the complete dismantling and rebuilding of Venezuela's state oil company, a process that could take a decade or more. From a legal perspective, Trump's executive order protecting Venezuelan oil revenues from court seizure creates a constitutional question. Companies like ConocoPhillips have federal court judgments entitling them to collect debts from Venezuela. Can the executive branch simply declare those judgments unenforceable? Legal scholars suggest this will almost certainly face court challenges. The separation of powers doctrine holds that courts, not presidents, determine how legal judgments are enforced. This could create years of litigation, further deterring investment. Political reactions have split along predictable lines. Republican lawmakers have generally praised Trump's aggressive approach to Venezuela as demonstrating American strength and reclaiming assets allegedly stolen from U.S. companies. Democratic critics argue the administration is overreaching, potentially violating international law and making promises about energy prices that cannot be fulfilled. Senator Chris Coons stated, Military intervention doesn't magically fix decades of infrastructural decay and institutional collapse. This is far more complicated than the administration is acknowledging. Expect continued negotiations between the administration and oil companies, with smaller independent firms potentially announcing preliminary agreements to conduct technical assessments in Venezuela. Chevron will likely announce modest production increases. However, no major capital commitments from ExxonMobil, Shell, or other supermajors are expected. Legal challenges to Trump's executive order on Venezuelan revenue seizure will begin working through federal courts. Gas prices for American consumers will remain essentially unchanged. Venezuelan oil production increases are many months away at minimum. If the interim Venezuelan government led by Delcy Rodriguez stabilizes and begins implementing legal reforms demanded by oil companies, we might see preliminary investment agreements announced with protective clauses and phase-based capital deployment. However, if political instability continues or violence escalates, major companies will maintain their distance indefinitely. The more likely scenario is that small independent companies make modest investments while majors wait for more certainty. Production might incrementally increase from 1 million to perhaps 1.2 or 1.3 million barrels daily. Helpful, but not transformational. American consumers will see no meaningful impact on gas prices from Venezuelan oil during this time frame. Let's recap the three most critical points. First, President Trump is asking for $100 billion in oil investment for Venezuela. But the CEO of ExxonMobil stood in the White House and called the country uninvestable due to unresolved legal issues and previous asset seizures totaling billions. Second, Venezuela currently produces less than 1% of global oil supply, despite having the world's largest reserves. Infrastructure collapse and decades of mismanagement mean rapid production increases are extremely unlikely regardless of political changes. Third, American consumers should not expect lower gas prices from Venezuelan oil anytime soon, and the promises being made are disconnected from operational reality on the ground. Here's the key takeaway. Political ambition, even backed by military force, cannot override economic fundamentals. When major corporations with fiduciary duties to shareholders refuse to invest, that tells you everything about actual risk assessment versus political rhetoric. What do you think? Will any major oil company actually commit serious capital to Venezuela in the next 12 months? Drop your predictions in the comments. If you want to stay informed on stories the mainstream media won't fully cover, make sure you're subscribed and hit the bell icon. The gap between what politicians promise and what markets will actually deliver has rarely been more visible than in this Venezuela oil situation. Thank you for watching, and I'll see you in the next one.